Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
We spent a lot of time, talking about the exciting parts of corporate finance.
Yeah.
The mergers and acquisitions, the big strategic moves companies make.
Right.
But underneath all that, there's this really vital function, Treasury, that's kind of like the circulatory system of a company's financial health.
It is. It's the heart of it all.
It is. It's making sure that cash is flowing smoothly. It's protecting against financial turbulence. And really directing capital to fuel growth.
Yeah.
And so that's what we're going to dig into today, the core of Treasury.
Yeah.
Managing liquidity, navigating risk, and allocating capital effectively.
Yeah. And for anyone listening, especially if you're in that corporate finance world, navigating that 3 to 10 year mark in your career.
Yeah.
Maybe you're in an FP&A or corporate development, even touching on strategic finance. Really understanding treasuries isn't just about kind of knowing another department exists. It's about sharpening your strategic lens, gaining influence across the organization, and ultimately accelerating your leadership journey.
I like that.
Yeah, and then, seeing how Treasury connects the dots in budgeting, forecasting, capital deployment, those big investment decisions.
Yes.
That you're likely, involved in.
Exactly. And our aim today isn't just to define Treasury.
Yeah.
It's to really extract the critical insights, the kind of practical knowledge that can immediately inform your perspective.
Exactly.
Okay, so let's get into it. The Treasury function fundamentally rests on three main pillars. Effectively managing liquidity, strategically managing risk, and making smart decisions about capital allocation.
Yeah, let's take liquidity management first.
Yeah.
This is the absolute foundation.
Yeah.
It's about ensuring the company always has enough readily available funds, whether that's cash or assets easily convertible to cash to meet its immediate obligations.
Right.
Think about those recurring necessities, payroll, supplier payments, interest on debt.
Yeah, those keep the lights on.
Right. If a company stumbles on its short-term cash needs, it's in deep water, regardless of how profitable the income statement might look.
Yeah, and you think about best-in-class liquidity management, I immediately think about Microsoft.
Absolutely.
They're a prime example, even through periods of significant economic upheaval, like the 2008 crisis and the pandemic.
Yeah.
Their treasury maintained a massive cash reserve. We're talking over $130 billion in cash and short-term investments.
That's wild.
It's huge. And what's interesting is how they achieved this through really sophisticated forecasting, a focus on highly liquid investments and strategic timing in the bond markets.
Right.
That level of liquidity didn't just keep them afloat. It provided significant operational flexibility and really bolstered market confidence during these uncertain times.
Absolutely.
Yeah.
What's fascinating is when you look at Microsoft and then you contrast that with a company like WeWork.
Interesting.
They secured billions in funding, yet their inability to control their cash burn and establish, fundamental cash flow discipline led to repeated liquidity crises. So it really underscores that simply having a lot of money isn't the same as effective treasury management.
Yeah.
And it suggests, potentially a disconnect between their rapid expansion and core treasury principles. A powerful reminder that growth without robust financial controls isn't sustainable.
Absolutely. Treasury can't operate in a silo.
Totally.
It needs to be a strategic partner, deeply involved in those high-level executive discussions. So moving to the second critical function, risk management, what are the key areas the Treasury oversees here?
Yeah. So in risk management, the Treasury team acts as the company's financial defense mechanism.
Okay.
They're tasked with, identifying, quantifying, and mitigating various financial exposures.
Okay.
The primary ones, include fluctuations in interest rates, movements in foreign exchange rates, and even changes in commodity prices, depending on, the company's industry and operations.
Right. So if you have a company that generates a significant portion of its revenue in, say, Japanese yen, but reports its financials in U.S. dollars.
Yeah.
Those constant shifts in the JPY-USD exchange rate can materially impact their reported earnings.
Yeah.
That's where Treasury deploys hedging strategies. They might use, financial tools like forward contracts or options
Right.
to essentially lock in exchange rates and safeguard those profit margins from unexpected currency volatility.
Exactly. And, a great example of a company expertly navigating this complex world of currency risk is Unilever.
Okay.
They operate in over 190 countries, dealing with, a vast array of currencies, the euro, the pound sterling, numerous emerging market currencies.
Wow.
And their Treasury team actively employs forward contracts and something known as natural hedging.
Natural hedging.
Yeah, think of natural hedging this way.
Okay.
If Unilever sells a lot of ice cream in Brazil and also sources its sugar locally in Brazilian real, that creates a natural offset against currency fluctuations between the real and their reporting currency.
I see.
What's really insightful here is, the deep level of coordination required between Treasury, their supply chain, and FP&A teams to execute these strategies effectively.
That makes perfect sense.
Okay.
And the third core function, capital allocation. This sounds like a really pivotal strategic responsibility.
It truly is.
Yeah.
Capital allocation is about making deliberate decisions on how the company utilizes its available cash and capital.
Okay.
This encompasses deciding how much to reinvest in the business, for future growth initiatives, how much to allocate to paying down outstanding debt obligations,
Right.
and what portion, if any, to return to shareholders through dividends or share repurchase programs.
And these decisions clearly carry significant weight.
Undeniably, poor capital allocation can directly impact the company's cost of capital. Essentially, the return a company needs to earn on its investments to satisfy its lenders and shareholders, and ultimately erode shareholder value.
Right.
Consider companies that loaded up on debt when interest rates were at historic lows.
Yeah.
Now, with rates significantly higher.
Right.
They might be facing considerable challenges managing those debt payments, limiting their flexibility to pursue growth opportunities.
Yeah.
It really highlights, the long-term ramifications of these Treasury decisions.
Okay, so we've laid out the three core functions of Treasury.
Yeah.
Now let's consider how the broader economic environment shapes the strategies and decisions of Treasury teams.
Yeah.
How do factors like prevailing interest rates and overall macroeconomic trends come into play?
These factors exert a profound influence.
Right.
Let's focus on interest rates, for instance.
Okay.
In a low interest rate environment, as we touched on earlier,
Right.
it can appear very attractive for companies to issue debt to finance expansion, acquisitions, or even to optimize their capital structure because the cost of borrowing is low.
Right.
However, when interest rates begin to climb, as we've seen recently, those very same debt strategies need a critical reevaluation.
Yeah.
Treasury teams need to carefully assess their mix of fixed rate versus floating rate debt,
Right.
the timing of refinancing existing debt,
Right.
and how to optimize their working capital to minimize their reliance on borrowing.
And we mentioned Ford earlier in the context of risk management.
Yeah.
How does their use of interest rate hedging specifically connect to this broader macroeconomic environment?
So Ford actively utilizes derivatives and interest rate swaps as a key tool
Okay.
to manage their exposure to these fluctuating interest rates.
Okay.
For example, when they issue long-term bonds with a fixed interest rate,
Mm-hmm.
their Treasury might strategically decide to use a swap to effectively convert that fixed rate into a floating rate or vice versa,
Oh, interesting.
depending on their outlook for where interest rates are headed and their overarching borrowing strategy.
I see.
This level of flexibility allows them to, potentially reduce their borrowing costs and manage the inherent risk associated with interest rate volatility in the broader economy.
So it gives them options.
Exactly.
That's a really clear illustration of proactive risk management in response to, economic conditions.
Yeah.
Now, what about the complexities of foreign exchange risk within this larger economic picture? We know it's a major consideration for multinational corporations.
Yeah, for companies that operate across international borders.
Right.
Foreign exchange risk is a constant and significant concern.
Yeah.
Unpredictable currency fluctuations
Right.
can substantially reduce profitability or make their products or services less competitive
Right.
in international markets.
Yeah.
Treasury's role here is to be incredibly forward-thinking.
Okay.
This involves, a detailed and ongoing analysis of the company's currency exposures. Where are they generating revenue? Where are their costs incurred? And in which specific currencies?
Right.
Also need to closely monitor geopolitical events,
Right.
macroeconomic indicators that could potentially impact currency valuations.
Makes sense.
Based on this rigorous analysis, they develop and implement hedging strategies
Okay.
that are closely aligned with the company's overarching financial objectives.
And Unilever, with its extensive global operations, really epitomizes a company that must have a sophisticated and proactive approach to this, right?
Absolutely. With a presence in so many countries and conducting business in so many different currencies, Unilever's Treasury team has to employ, a highly sophisticated approach to managing FX risk.
Right.
Their consistent use of forward contracts and the natural hedging strategies we discussed earlier are indispensable tools for protecting their bottom line from the impact of, unpredictable currency movements. The crucial point to understand here is that effective FX risk management isn't just a technical exercise in using financial instruments.
Okay.
It demands, tight coordination
Right.
and alignment with the company's supply chain decisions, its sales strategies in diverse markets, and the comprehensive financial planning
Yes.
carried out by the FP&A team.
Okay, so we've explored the fundamental Treasury functions and the influence of economic factors on their strategies.
Yeah.
Now let's shift our focus to how technology is fundamentally reshaping the Treasury landscape.
Yes.
It's surely evolved significantly beyond the days of just spreadsheets, hasn't it?
Oh, without a doubt. The evolution of Treasury technology has been transformative.
Yeah.
We've transitioned from an era heavily reliant on manual processes and spreadsheets
Right.
to one where sophisticated technological tools are becoming increasingly indispensable.
Yeah.
Today's leading Treasury teams are leveraging, real-time dashboards that provide an immediate consolidated view
Okay.
of their global cash positions.
Advanced AI-powered forecasting tools that can predict future cash flows with much greater accuracy.
Wow.
And automated cash pooling systems
Okay.
that significantly optimize how cash is managed across various entities within a corporate group.
So can you give us some specific examples of the types of technology platforms that are now prevalent in treasuries?
Certainly, you have major enterprise software providers like SAP Kyriba and Oracle that offer comprehensive treasury management systems.
Okay.
These platforms are specifically designed to integrate seamlessly with a company's broader enterprise resource planning ERP system.
Right.
This deep level of integration provides CFOs and treasury professionals with significantly enhanced visibility into their global cash positions, enables them to run sophisticated simulations of various financial risk scenarios,
Okay.
and dramatically streamlines crucial processes such as intercompany lending.
And what are the key advantages of this increased automation?
Yeah.
It sounds like it could free up treasury teams to focus on more strategic work. That's a central benefit.
Yeah.
By automating many of the routine and time-consuming tasks, such as, bank reconciliation and payment processing,
Right.
treasury teams can significantly reduce the time and resources they dedicate to these more manual, often reactive activities.
Yeah.
This newfound efficiency frees them up to concentrate on more strategic initiatives,
Okay.
such as developing proactive capital strategies and focusing on long-term financial planning, rather than being primarily consumed by day-to-day cash management.
Right.
It represents a significant shift from a primary focus on operational efficiency to having greater capacity for strategic thinking
I see.
and long-term planning.
Do we have a concrete example of a company that's effectively leveraging this kind of advanced treasury technology?
Salesforce provides an excellent example.
Okay.
They utilize AI-powered forecasting tools that are directly integrated into their ERP system.
Okay.
This integration allows their treasury function to generate rolling cash flow forecasts and to conduct various scenario analyses, evaluating both best case and worst case outcomes.
Okay.
The ultimate objective is to gain real-time actionable insights that enable faster and more informed decisions regarding the management of their working capital, the allocation of investments, and the management of their foreign exchange exposure.
Wow.
It really underscores how technology can empower Treasury to evolve into a much more strategic and influential function within the organization.
This has been a really illuminating look into the crucial role of Treasury.
Yeah.
So bringing it back to our listener, that corporate finance professional with a few years of experience,
Yeah.
what are the key takeaways for them? Why is understanding all of this so important for their career trajectory?
That's a critical question.
Yeah.
If you're currently working in FP&A, actively involved in M&A transactions,
Right.
or contributing to corporate development initiatives, it's essential not to overlook the Treasury function.
Yes.
Understanding how your financial forecasts directly influence the company's cash flows and overall liquidity position is paramount. Similarly, recognizing how the strategic capital allocation decisions you might be contributing to
Yeah.
will ultimately shape the company's financial risk profile is crucial.
Yeah.
Even taking the initiative to learn the fundamentals of hedging strategies and the principles of effective liquidity management can significantly enhance the value you bring to your current role.
And it sounds like this foundational knowledge isn't just beneficial for those directly within a Treasury department. It has broader career implications.
Absolutely. If you have aspirations to advance into more senior leadership roles within finance, such as a CFO or a strategic finance leader, developing a robust understanding of Treasury is absolutely indispensable. It forms the bedrock of sound capital stewardship. You need to grasp, how to manage liquidity effectively,
Right.
how to strategically mitigate financial risks,
Yes.
and how to make well-informed capital allocation decisions that will drive long-term value creation for the company.
This has been a truly fantastic deep dive into what is clearly a critical function within any organization.
Yeah.
So, as a final thought for you listening,
Right.
I want you to consider this a well-functioning Treasury department, while often operating behind the scenes, possesses significant strategic power and is absolutely vital for companies' long-term success
Yeah,
and overall resilience in a dynamic marketplace.
absolutely.
Think about how gaining a deeper understanding of Treasury can elevate your own contributions and your strategic impact within your current organization.
Yeah.
And if you're looking to explore these specific areas of liquidity planning, risk hedging, and Treasury operations in even greater detail, remember that there are valuable resources available that can provide that more in-depth knowledge.
Agreed. Stay inquisitive, stay strategic.
Yes.
And never stop expanding your understanding of these critical financial functions.
Love it.
Until our next deep dive.
I can't wait.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.